Most Canadians treat their RRSP like a savings account with a tax receipt attached. Put money in, feel good about the deduction, move on. But the RRSP is actually one of the most sophisticated tools in the Canadian tax code, and used incorrectly, it can cost you tens of thousands of dollars over a lifetime. In this video, I'm going to walk you through 5 RRSP mistakes that are shockingly common, even among high-income Canadians, and exactly how to fix them. The RRSP isn't just a retirement account, it's a tax deferral machine. Every dollar you contribute reduces your taxable income today, grows tax-free inside the account, and gets taxed only when you withdraw, ideally at a lower rate in retirement. But that logic only holds if you're using it strategically. If you're not, the math works against you. Let's get into it. Mistake number 1. Contributing without knowing your marginal tax rate. The whole point of an RRSP deduction is that you get back roughly your marginal tax rate on every dollar contributed. If you're in a 43% marginal bracket in BC, a $10,000 contribution effectively costs you $5,700 after your refund. But here's where Canadians go wrong. They contribute in a low-income year, expecting the same benefit. If you're between jobs, on parental leave, or in your first year of a new business, your marginal rate might be 20% or lower. Contributing now and withdrawing in retirement at 30%. That's a losing trade. The fix: match your RRSP contributions to your highest income years. If you're an incorporated professional or a salaried employee expecting a raise or bonus, that's your window. Carry forward your room and use it when it counts most. Mistake number 2, ignoring the TFSA and FHSA before the RRSP. The RRSP gets the most marketing, but it's not always the right first move. For many Canadians, especially those early in their careers or with modest incomes, the TFSA is actually the better account. Here's the simple rule. If your current marginal tax rate is lower than what you expect in retirement, contribute to your TFSA first. The TFSA gives you tax-free growth and tax-free withdrawals with no strings attached. The RRSP defers tax. It doesn't eliminate it, and if you're saving for a first home, the FHSA should come before both. It gives you an RRSP-style deduction on contributions and tax-free withdrawals for a qualifying home purchase. That's a double tax benefit that the RRSP simply can't match for first-time buyers. Use the right tool for the right job. Mistake number 3. Holding the wrong assets inside. Not all investments belong in an RRSP. This is called asset location, and most Canadians have never heard of it. Here's why it matters. Inside a registered account like the RRSP, all growth is taxed the same way on withdrawal as ordinary income. That means you lose the preferential tax treatment that Canadian dividends and capital gains normally receive in a non-registered account. So what belongs in your RRSP? U.S. equities and bonds. U.S. dividends are taxed as foreign income in a TFSA, but the Canada-U.S. tax treaty exempts them from withholding tax inside an RRSP. That makes your RRSP the ideal home for a fund like VUN or a U.S. index ETF. Canadian equity ETFs like XEQT or XIU, which generate eligible dividends. Those are better held in a non-registered account where the dividend tax credit applies. It's a subtle shift, but over a 25-year horizon, proper asset location can add meaningful after-tax value. Mistake number 4, withdrawing early without a strategy. Life happens, a job loss, a major expense, a business opportunity. And the RRSP can feel like an emergency fund option. But early withdrawals are expensive in a way most people don't fully calculate. First, your institution withholds tax at source. 10% on withdrawals under $5,000, 20% up to $15,000, and 30% above that in most provinces. But that withholding is just a down payment. The full amount gets added to your income for the year and taxed at your marginal rate. If you're still earning a salary, that withdrawal could be taxed at 40 to 50%. Second, and this is the one that stings, you permanently lose that contribution room. Unlike the TFSA RRSP room, does not come back when you repay. That room is gone forever. If you need liquidity, exhaust your TFSA first. Mistake number 5. Ignoring the spousal RRSP. If you and your partner earn significantly different incomes in retirement, you will pay more tax as a household than you need to. The CRA taxes individuals, not couples. So 2 people, each earning $50,000 pay less combined tax than one person earning $100,000. The spousal RRSP is designed to fix this. The higher earner contributes to an RRSP in their spouse's name, gets the deduction at their higher marginal rate, and at retirement, income is split more evenly between both partners. This is especially relevant for incorporated professionals who control their own compensation. One important note: contributions must sit in the spousal RRSP for at least 3 calendar years before withdrawal, or the attribution rules kick in and the income gets taxed back to the contributor. Plan accordingly. Here's your checklist. 1. Know your marginal rate before you contribute. 2. Use the FHSA and TFSA first if they fit your situation. 3. Hold U.S. equities in your RRSP, Canadian equities in non-registered. 4. Treat RRSP withdrawals as a last resort. 5. If your household has an income gap, the spousal RRSP is one of the most underused tools in Canada. If you found this useful, subscribe. We publish evidence-based investing content for Canadians every week, with no hype and no conflict of interest. And if you missed our TFSA mistakes video, that's linked right here. See you in the next one.